Okay, I think we can start now. I know people are still, showing up a little bit, but let's kick it off. So firstly, everyone, happy Thursday and welcome to our weekly podcast. I'm very honored and flattered to have a very impressive person to talk about private placement life insurance, which we affectionately call PPLI. So this is a very sophisticated and very powerful product. And it's coincidentally a product that I've been happy to work on when I ran the private wealth practice for McKinsey, because the partners of McKinsey all opted into that product. So it was well vetted. It's a product that honestly we could spend hours and hours on it. So I'm really going to try to stay at a high level here so we get through the overview. It's a simple concept to understand, but there's a lot of permutations which get complicated. But net, think of it as another deferred tax vehicle. And you can say, what's a deferred tax vehicle? Well, your 401k plan is a deferred tax vehicle. As long as money's sitting in there, it compounds tax-free and you only pay tax when you pull it out. So private placement life insurance serves a similar role. So as the wealth is in the policy, it compounds tax-free. So let's go to the next slide, please. So yes, we have to have a disclaimer. You're welcome to read this at your leisure, but the bottom line, we're here to give you education. We are not here today to give you investment advice, okay? So this basically says, if you have an investment advice, work with your investment advisor, but here we're trying to educate you. So that's essentially what the disclaimer says. So go to the next slide, please. So in private wealth for Bridgepoint, we consider private wealth a four-legged stool. So your net worth, which combines your investable assets and your personal assets, things like your house, your jewelry, your real estate, your cars, et cetera, all that in combination is your net worth. And you want to grow that prudently and aggressively as best you can. Trust and estate planning has this important role to play in wealth management. I'll just tell you, in America, anybody can sue anybody at any time. So you want to have financial moats around your net worth. You may have desires about when you pass, where the money goes. So there's a lot of things around trust estate planning that we can be helpful with. Tax planning is another element. And today's session dovetails in both tax planning and insurance. But tax planning, I tell people, and I'm a former CPA, a monkey can do a tax return. That's not the gift. The gift is tax planning, emphasis on the planning. Because if you have a future taxable event, you can take steps to plan accordingly to minimize your tax burden. And the beauty of tax planning, you can document to the penny the value you're creating because you know the savings you generated for someone. So tax planning is an important element. And insurance for us is primarily private placement life insurance, which is something we're talking about today. So go to the next slide, please. So just as a reminder, two things on the investable asset side. The pie chart to your left documents the key to investing is getting your asset allocation right. Things like security selection and market timing. I always use the example of Jim Cramer, Mad Money. That's the deal of the day. And honestly, it doesn't work. They've done studies of Cramer's recommendations versus a passive index, and he doesn't beat it. It's entertainment, it's fun, it doesn't generate wealth. Getting your investments correct is the game. And if you look on the right, just briefly, this is the optimal portfolio that I previously deployed, and it shows you the breakdown. But the important point of all this, you have three separate portfolios. One portfolio is 100% equities, which has obviously a level of return, roughly 11% over the long run, but it has volatility about 17%. So it's a very inefficient portfolio. You can go 100% fixed income. It's less risky, but less return. Versus the optimal portfolio, which is in the left top quadrant, which is where you want to be, where you have the highest return with the least risk. That's what you want. And this portfolio delivers that. It gives you more return than 100% equities and less volatility than bonds. So that's the solution that we advocate. And we offer here, we basically say diversification is the only free lunch. And we're happy to work with people if they want to spend, I'll say invest the hour with us to go through our playbook to educate you on how this investment process works and to show you a case study of how we deploy this. So if that's of interest, you'll see at the end of the presentation, our email, you just contact us and we can schedule a time to go through that with you. Okay, next slide, please. Yay, now we're getting to the fun stuff. We're here because of Courtney, and I'm honored to have her here. So I'm going to let Courtney Macaulay just spend a few minutes, a minute or two, just giving us her background and why she's here today.
Thank you. Yeah. My name is Jennifer Hamilton Macaulay. My firm is BHJ LLC, and my broker dealer is Stern Capital. So that's where you see Stern Capital. Private placement life insurance, essentially, in a nutshell, is a better way for a wealthy client to better manage their after-tax returns. Our firm, BHJ, was started in the early 90s by my father, Dean Hamilton, and he at the time kind of started his own business based off his experience running or co-running insurance companies in the 80s, always focused on the investment side of that business, looking for distribution opportunities that required low overhead, institutionally priced, but very much focused on the investment side of the insurance business. He at the time was a consultant to a very large fixed income manager, Offutt Bank at the time. They've evolved into a couple different firms since then, where they created a very simple kind of 20 basis point retail annuity wrap around one of their fixed income strategies. And very quickly, with their client base, raised assets, just using the concept of tax deferral, until one of their biggest clients said, why wouldn't I use life insurance and make that whole portfolio income tax free? And that kind of launched us into this space. To date, we've done hundreds of these structures. Private placement life insurance and private placement annuities are the only business we do. I am insurance licensed, so I satisfy the broker side, but I'm not a traditional insurance agent. I've never kind of sold a whole life or a variable universal life policy. It's strictly been kind of working with, whether it be registered investment advisors, multifamily offices, wealth management practices, investment firms that cater to individuals. And it's always kind of working on their behalf to introduce this concept to their end client, to kind of present what they do and to help them better manage their after-tax returns. It's a very popular structure right now, given the current tax environment. And as well as, returns have been relatively pretty good as well.
Okay. Well, first of all, you're going to have to forgive me for mispronouncing your name. So that's
all right.
Apology for that. I'm doing too many things at once, so I apologize.
That's okay.
You can see my background. I'm not going to bore anybody with it, but let's go to the next slide, please. Okay. So basically, the bulk of this next section or session is going to be Jennifer describing private placement life. But at a super duper high level, it gives you the ability to defer taxes on your investments. That's what we used it for at McKinsey, but we also used it for trust estate planning. So it has other side benefits. But Jennifer basically said she got into this business because she wanted tax deferral. And tell me anyone that doesn't want tax deferral, because I don't know of it. And the beauty of this product has become much more mainstream. When I launched it, your liquid net worth ideally was 20 million and above to make the math work. But it's become much more mainstream, more affordable. So that 20 million, Jennifer, would you say 2 million is the lower end of the range to do a policy like this?
Yeah. So if you think, and I'm not sure what the insurance knowledge is of everyone here on the call, but basically a private placement life insurance policy is very focused on creating an investment story using the tax benefits that are in all insurance policies. So unlike a traditional insurance policy where you're solving an insurance need, here is the opposite. You are, a client will come and say, I have X amount of capital. I'm interested in funding into this. You would typically fund it over 3 or 4 years. And given that scenario, we would look at the insurance code and solve for the minimum amount of insurance required, to give the tax benefits that are present in all policies. And those tax benefits include, starting day one, when you invest inside a private placement structure, your monies will grow income tax free forever, as long as the structure stays in place. On the investment side, this is private placement, so you do have the ability to invest in non-registered investment options, including alternatives. You are not confined to what you might see in a traditional retail policy. The carrier is not going to manage your money. And, if you do choose to invest in a registered investment option, usually it'll be at a very low institutional class. They'll make that the lowest cost available. But basically your money grows income tax free. You can reallocate pending the liquidity of what you're invested in at any time without incurring an income tax event. I mentioned that typically these policies are structured over a period of years. So the minimum right now on a private placement life policy is typically $2 million funded over 4 years. So $500,000 a year. And when your money is funded in over a period of years, it creates what's called a non-modified endowment contract. And that gives a client the ability to access their monies during the lifetime of the policy without incurring an income tax event. So if you wanted to borrow off of it, you could do that. For a pretty low cost loan charge. It is a true redemption out of the investments, but you could access your gains without incurring an income tax event. And you can always take out your principal after year 7 if you wanted to, if you needed to access it, you could do that as well. And then finally, at death, the investment portion becomes part of the death benefit, which passes income tax free to the beneficiary. Depending on how the policy is structured, you could have estate tax favorability as well. But the real focus behind this is creating, a very tax efficient portfolio that maybe wouldn't be that way on the taxable side.
So, Jennifer, what I heard you say, I'll just repeat it back.
Yeah.
If I have $2 million that I fund over 4 years, I have the minimal amount to qualify for what an insurance carrier would offer me for private placement life. Okay.
Yeah.
Now, there are people on the call that have 2 million liquid now to do this. There's people on the call that don't have 2 million to do that. However, knowing that this, I'll just say, solution exists, I think is really important. People need to know if and when the need arises, what they can do. So this is an arrow in the quiver for tax minimization. If
correct.
you use it today, great. If you can't, no problem. At least you know it exists. And I'm using my simplistic brain here, but how did this come to be? My opinion, and correct me if I'm wrong, insurance companies have powerful lobbyists in Washington. So they've created a legal tax deferred vehicle here. And people now know how to access it through private placement life. So yeah, there's 401k plans. Yes, there's IRAs, there's Roth IRAs, but there's also this thing called private placement life, which gives you another tax deferred vehicle. And the beauty, you can borrow, as you said, on this policy. Your money's compounding tax free, but you can get access to it.
Yeah, I think too, it's important to stress that private placement life policies are regulated the same way as retail insurance policies. So it's, they must abide by 817H, which is a diversification rule on the portfolio. And there are investor control rules, meaning however you're investing inside the policy, the client can't outwardly control that portfolio. They can have a third party do it on their behalf, but that third party should have full discretion. Yep. But it's the same it's the same rules that are being regulated on both. The difference is you're really minimizing what's needed on the insurance side, versus solving for an insurance need. And I will stress that the overall cost of private placement is substantially less than a retail insurance policy. Insurance commissions are a fraction of what you might see on the retail side. And the overall insurance cost that the carrier charges, including COI rates, is substantially lower. And that's, they're in this, not every carrier does this type of business because it is a low margin business for the carrier, but with very high dollar amounts going in. So their mortality and expense fee might be 45 basis points all in versus on the retail side, that might be at least 150 basis points going up. So it's very much an institutionally priced, insurance vehicle geared towards, tax efficient investing. It is private placement. You need to be a qualified purchaser to participate in the product. So there is, you do need to fill out, appropriate paperwork that verifies net worth from that standpoint.
All right, well said. Let's go to the next slide. So this, I'll let you, Jennifer, explain this chart, but it basically shows you how avoiding taxes compounds your wealth over time.
Yeah, I mean, this is strictly just, when you invest inside private placement life, you are not incurring any taxes whatsoever on your investment portfolio. So monies, if you, depending on what a turnover rate is on a portfolio, that's what it shows below in the light green, what you might keep on the taxable side versus on private placement. If you have, $10 million going in, you're not paying tax on anything, no growth, nothing. The carrier actually is responsible for all reporting on that portfolio. So if what you're invested in generates K1s, that is not the policyholder's responsibility. It's the carrier's on behalf of the policyholder. So many clients find that extremely attractive, particularly around tax time. And they don't need, basically to worry about this investment portfolio.
I'll say they don't have to go on extension because that's what happens because none of these K1s arrive on time and people hate to go on extension, but that's typically what happens. I lived through that. Okay, that's super helpful. So let's go to the next slide. So the middle column, and Jennifer, walk us through this, but this is the guts of what distinguishes private placement versus a taxable investment on the left. And another version of private placement life is the private placement variable annuity. If you don't mind, I'd love you to concentrate on taxable investment versus PPLI. Is that okay?
Sure. So it's, again, when you invest on the taxable side, you are not investing on a tax deferred basis. Your portfolio is going to be taxed however it's invested each year. With private placement, as mentioned, whatever you're invested in, it's going to grow income tax free forever as long as the policy stays in place. Again, income tax elimination, no on the taxable side, but on private placement, yes. And the only caveat would be if for some reason you decided to surrender your policy. There are no surrender fees on private placement life policies. You can, if you decide in year 10 that you just don't want the policy, you can surrender the policy where, money's paid to you depending on the liquidity of what it's invested in, as it comes due. And any gains, though, will be taxed as ordinary income in that year. Okay. Estate tax elimination. Again, depending on how the ownership is structured on the life policy, there could be some estate tax favorability. You are generating a pretty significant death benefit, even if you're just solving for the minimum on the amount of premium going in. It still provides, an additional step up at death because, there is life insurance on top of your investment portfolio that becomes overall part of that pool that goes to your beneficiary.
Jennifer, can I just stop you on that? I just want to
Yeah,
make sure everyone understands what you just said. I'm going to use my words, so correct me if I'm wrong.
yeah,
For these private placement life policies, it's being used for its tax-deferred vehicle benefits. However, it has to qualify as life insurance. So there's
correct.
a minimal amount of life insurance that the policy needs, depending on what additional assets are placed inside the policy. So if you have $3 million liquidity into the policy, you need a certain level of death benefit. If it's 30 million, you need a greater amount of life
Yeah.
insurance to justify that ratio.
Yeah. So the death benefit, what is the minimum amount determined on a policy is going to, you do need to go through medical underwriting. There's insurance involved. And I would say that, the carriers, we've done a really good job of keeping it, as simple as possible. Someone can go right to a client, do what they need to do. The client, they don't need, we're not looking to create a lot of work for the client on that side. And the minimum amount of insurance required is going to be based on, is the client male, female, what is their age? Are they preferred? Are they a non-smoker? That type of thing. So it's the older you are, the less insurance required for dollar going in versus the younger you are. The cost of insurance rates tend to be less when you're younger. However, more is required on a portfolio. This is just what's in the insurance code than when you're older. So it kind of all balances out, to be, similar. We think the average annual insurance cost is about 25 to 30 basis points, just what the average cost is. And these cost of insurance rates that the carrier charges, they're not building profitability into them. So they're, typically the rates go right to the reinsurers. The carrier isn't, building additional revenue on them. And the reinsurers are all top rated, like Swiss Re, Gen Re, very top rated reinsurers in the marketplace. So that's where, there is going to be an insurance component on the that is on the policy that you can actually reduce after year 7 if you wanted to, but that's, we're getting technical. So.
Talk a little bit about borrowing on the policy, how that works.
So as mentioned, starting in year 1, if you wanted to, you could borrow, private placement life policies are funded with cash. So I'm just going to say that outright. So it's when monies go in, it's funded with cash. You can take money out during the first 7 years as a policy loan, and that would include on the money that you've put in. If you wanted to access your basis during the first 7 years, it would need to be done via the loan provision. After year 7, you can access your basis without incurring a loan charge. It can just come out. And if it comes out, you can never put it back. If you take your basis out, it's like a permanent withdrawal. But you can access gains and your basis prior, to year 8, and gains can be accessed at any time, but they will always come out as a loan. And as I mentioned, the carrier is not fronting the loan. It's a true redemption out of what you're invested in. And it's paid, right to the owner. That amount, the carrier will carry that amount as an asset in their general account for accounting purposes. And they charge a loan charge annually. And typically that loan charge is the same as what they would be getting if that amount were still in the policy as a mortality and expense fee. So, the client can pay a loan back at any time. And when they pay it back, if there was interest, the loan's paid back with interest, but the carrier's not keeping the interest. It all goes back to the client. And so we do have clients. Most people go into this and they're not looking to take money out, but I do have clients that have used the loan provision, maybe used it for a real estate transaction where they took it out and then put it right back in. Or they might have used it for a taxable investment that they couldn't get inside the policy and they haven't paid it back. So it's, the thing to stress is there is a lot of flexibility, and being that there are no surrender fees, it's your money, you can access your money. And it's, through the low cost, and it is a low cost loan provision, but there is flexibility on that side if you needed to, and you can pay it back or not pay it back.
I know interest rates move around quite a bit, but
Yeah.
give me your best guess if someone borrowed on their policy today, what the loan charge would be.
So thinking of one carrier, their interest rate, what they might charge on the loan each year could be 4.35%. Then they have a crediting rate that they might credit back against it of 4%. And that spread is the actual loan charge that a client would not get back on the loan amount, the 35 basis points. But that could be equivalent to what would have been charged on that investment value via the mortality and expense fee, which is a capital charge that's done annually. So it's, if you, each year, they'll look at the loan interest rate, and the client can pay the interest back if they want, or it just gets collateralized and becomes part of the new loan balance that's carried into the next year. And the reason they do that is if a client wanted to pay the whole loan amount back, they would do so. It would include that interest that's been collateralized, but all of it goes back into their investment policy for themselves. If there was a death and there was a loan outstanding, the amount is deducted from the death benefit before sent to the beneficiaries.
Okay. All right. Very good. Let's go to the next slide. So here we have a case study. Now we get to put all this theory into practice. So
Yeah.
Jennifer, walk us through what the chart is trying to explain here so everybody understands.
Yeah. So in this instance, and what they used here was someone that funded their monies in all at once in 1 year. When you fund your money in the first year, that creates a modified endowment contract, which actually you would not have the ability to access your money during your lifetime, from a loan perspective. But there are clients that are truly looking at this from an investment perspective, and they just want the money at work inside the policy and they're not going to touch it. So, for illustration purposes here, this particular client, he's a 75-year-old resident of New York City. He maintains a traditionally managed portfolio with a large private bank. Here, we see this a lot. Many clients, maybe they're invested with someone that has the ability, that's already offering themselves inside a private placement life policy with a particular vehicle that is insurance approved. Or maybe they're looking to kind of expand their traditional way of investing with very would typically be tax inefficient investments, but inside the policy are now tax efficient. So it's, as mentioned, you have the ability, inside a private policy to either pick off of a menu of what's available, or you can use an advisor to create a customized account on your behalf. Many clients, they do view the fact that K1s are not they're not responsible as a positive. So many clients, they're tired of the tax component on their taxable investments. And that's the real driver of getting into this. So here, this client, has the ability, they decide to fund $10 million in year one. And basically, they were comparing it against what a taxable account value would be. Now, this gets into kind of talking a little bit about what the typical fees are inside a policy. Life insurance policies are all subject to premium tax. You don't see it on the retail side because the carrier might front those taxes on behalf of the client, and then they build that into their pricing. In our world, we believe it is more efficient to have the taxes deducted right off the capital or the premium as it comes into the policy, and it gets sent to the various, state entity and federal entity. And then, once it's almost like a transfer tax, and then, your money's invested and it grows. So in the beginning years of a private placement policy, you'll see here, kind of the taxable is in the gray versus tax-free in the more fluorescent color. So very quickly, the monies, if you're comparing between the two, grow very quickly. In the beginning years, because of the premium tax, it's not as evident, but it grows pretty quick. Right off the bat, you typically have gains, an advantage in year one that just keeps getting bigger and bigger over time because of the tax-free growth. Here it talks about, the mortality and expense fee, and this is just used as an example for illustration purposes. Many carriers will charge their mortality and expense fee, which pays for administration of the carrier. It's their capital charge. And, it can vary by asset value. It includes our pricing as a broker for a servicing fee. But all of it, it's an annual charge on the investment portfolio taken out monthly. But this just talks about, here they're assuming a 75% portfolio turnover rate on the taxable side, income tax bracket of about, 53.5%, which I know, could be higher. And again, in this instance, they were kind of looking at male, preferred, and they cite us the policy in South Dakota, which has a preferred state premium tax. So it's just talking about the power of tax-free growth. And for that, the client has the ability to invest in the traditional and alternative asset classes, elimination of K-1 reporting, and it just talks, about, being the fact that it is insurance. So you need to do the steps required to get the insurance, but it's really a tax-free growth story against what would be on the taxable side.
I guess, Jennifer, in this case study example, the policy owner is 75 years old.
Yep.
And I'm just saying it because it's hypothetical, but how tough do you think it is to medically underwrite a 75-year-old?
So, I would say the average underwriting age is all the way from mid-30s, and probably 75 could be the higher end, 78. I think, we've, for the most part, I can probably count on one hand the number of clients that we've had difficulty, where we haven't been able to get underwriting, and then in which case they might underwrite the spouse with the same owner. One of the interesting things in this marketplace is I do think the reinsurers look at it a little differently, given kind of the overall, typical profile of the client. Many clients in this marketplace, they tend to be very on top of their health. If there's something wrong, they immediately go to a specialist, and, they have access, to very good medical care. So I think health issues that might arise at age 75 would be looked at differently than if those same health issues were in a 45-year-old, if that makes sense. And one thing that is interesting, given that we're solving for the minimum amount of insurance, when you have a client, we've had clients that maybe, they're not preferred, they're not even standard. They could be a table 2, table 3, those are rating classes. When you start getting into the table classes, the rates are a little higher, but actually then the amount of insurance required does drop. It's something that's in the insurance code that kind of balances out if there was a higher insurance cost.
That's a good point. Thank you.
And one thing to mention, there is survivorship private placement life available as well. So we do find sometimes if someone is not in particularly great health, if they do a survivorship with a healthier spouse, or if they don't want to do it just on their spouse, that can help on the underwriting side as well.
Okay. Actually, I was not aware of that one. That's a
Yep.
newer wrinkle. So thank you for that. Let's go to the next slide. So I want to open it up for questions, and we do have a hard stop in about 15 minutes. So I tried to keep enough time for people to ask questions, but we always want to leave with some key takeaways. So Jennifer, you want to give us what you think are the key takeaways from the session?
Yeah. I mean, we always say to prospective clients or our partners that we're working with, private placement life insurance, look at it as a concept. It's probably one of the last tax minimization tools available to a wealthy client. A client doesn't have to do it. I mean, we very much are in an education business where we feel it's good for clients to be aware this is available, but not every client's going to do it. And we've had clients 5 years later that have shown up and been like, remember me? I think I want to revisit this again. But I think it's prudent just to be aware that it is available because it's being talked about so much right now. I would say, the big value proposition is, well, what would be my incremental cost to get these tax benefits versus just staying with my taxable portfolio? And, insurance is viewed by many clients as being very expensive, and high net worth clients don't feel that they need it. I will say, to get the tax benefits, clients are willing to go through what they need to get the insurance. And if it's priced right, and we truly believe, we as a firm are a very low cost provider, and we have been since day one. And that probably came off of my father's vision that a high net worth client should be treated similar to an institution, and you have to price it that way. So the incremental cost to get these tax benefits on top of what you normally would pay on the taxable side, because that taxable versus non-taxable on the investment portfolio should really be the same. We rarely see managers that are marking themselves up inside insurance. They just want to be kind of equal inside or outside, if that makes sense. Should really be in about the 80 basis point range going down over time. And that 80 basis point would include all insurance costs, to get the tax benefits. And that's the actual cost of insurance, and then the mortality and expense fee. And then, or like a broker pricing, the premium tax that's upfront on premium as it comes in, we view that as you can view it as a necessary transfer tax just to get inside the policy. But we think it's a very powerful tool. We feel it's very vetted, with the service, because it is regulated just like retail insurance products are. The one gray area that might get attention that we are very mindful of is how monies are managed inside the policy. And there's a very clear roadmap of what is allowed and what isn't allowed, from investor control, diversification, that we feel very comfortable, that it's a product, that we don't foresee, going away at all.
Let me just add to what you just said about diversification, and I'll just say investment management within the policy. I'm going to relate it back to what I previously did at McKinsey, but basically the objective of the partners was to take this phenomenally successful, I'll just say, hedge fund program that they had that generated a lot of taxable income, but a lot of ROI at the same time, and put it in the policy. So firstly, you need a trustee. You mentioned that it's someone that you appoint, you hire, but they're independent and they have full discretion on what's inside the policy.
Correct.
So, it is what it is, but most people, if you think about it, they're independent, but you hired them. So how independent are they? That's my assessment, okay? That's not the official insurance perspective on this. But yes, you need an independent trustee that oversees that portfolio, and it needs to be diversified. So you can't have, I'll make a silly example of everything in the policy owning commodities, because commodities are highly volatile. This year, they did phenomenally well, but they won't always do phenomenally well. But inside of a diversified portfolio, they have an important role to play. So net, you have to be comfortable with a trustee that will oversee these investments. Now you can basically say, I'll do all this investing stuff, or the insurance company has a program and managers, so they've set it up so you don't have to do it yourself. You can have the insurance company and the managers that they've put on their platform provide this offering to you. So if you don't mind, Jennifer, on the alternative side, what are the, I'll just say, household names that are involved with this from the insurance standpoint? I know we've talked about this a little bit.
Yeah, no, I think, and that this is a platform that's evolving. I mean, the amount of managers getting into the space, increases all the time, but they're on the alternative side. You have firms like Millennium, Golub, Golden Tree. It just keeps evolving. And I'm happy, Mark, I'm happy to send over, some examples of platforms, if you think that's helpful. But it is, I think when we first got into it back in the early 90s, there wasn't a huge comfort level on behalf of the carrier with what they could make available, because it's any fund that participates in the insurance space, they go through a pretty significant due diligence process with the carrier. So many of these carriers were comfortable only with, fund of funds, multi-manager, multi-strategy fund of funds. And now that has really evolved. I mean, they're very sophisticated, investment teams that are looking at managers. They're willing to work with funds that have a lockup, like more than, it could be, 7-year lockup. So it's, they're very much interested in providing a very attractive, platform that a client can look at if they don't want to bring in, if they're not working with a managed account advisor. So that's been something that's really been great, I think, for the client base, because you have a lot of clients that are very sophisticated investors, and they want to try to replicate what they do on the taxable side.
No, that's very well said. So we have about 5 to 10 minutes, and I would like to open it up for any questions from the audience. So if you do have a question, this is the opportunity to either put it in the chat box or just, unmute your recording and let us know what questions you have.
Hi, Jennifer. My name's Lori, and I missed the first 5 minutes. So can you explain, are you on the insurance side? Are you the broker?
Yeah. So I serve as a broker. We got into this space back in the early 90s. My firm, BHJ LLC, was started by my father, Dean Hamilton. And we've kind of over the years, we've served in many different capacities. We've been a consultant to some of the carriers in the space, helping them get into the space, onshore and offshore. We've worked as a partner, to many larger firms where we help introduce the concept to their end client, kind of their resource in this space. We are a broker. So yeah. My pricing.
So you work with different carriers. Right?
I
do. I'm familiar with Evergreen. Do you work with them?
We do not work with Evergreen. Okay. I am familiar with them though.
Okay. Yeah, so they insure not necessarily the person, but a group.
Correct.
Right?
Yep.
Okay. Can you speak to that a little bit, like pluses and minuses on that, or why you
I
don't
think
work with them?
they're just in a very different, they approach the marketplace differently than we do. Is just what I would say.
You're
Okay.
being polite. We don't negative sell on this call, okay?
Yeah.
No.
Yeah.
I
Yep.
mean, yeah, I'd love to know if you have any insight, but
Yeah.
maybe.
We can have a separate chat and you guys could talk after this
Sure.
one-on-one and explore,
Yep.
pros and cons of different things. But I will just tell you personally, I think Jennifer, firstly, she's not bound to any single carrier, which is important because
Yep.
many people in the space essentially are house salespeople for one carrier. And that's not the case with Jennifer. Jennifer, you work with roughly 4 or 5 major carriers? Is that fair?
Yeah. Yep. So we're not an M group firm, meaning we've never been a traditional, life insurance agency. So the carriers that we work with, Lombard International, Zurich, Prudential on the non-M side, some work with Crown Global. I think our real area, we've just been very good at domestic, US compliant policies,
Yeah.
onshore and offshore.
Okay.
And-
So, but you mentioned 80 basis points. Are you including the broker in that?
Yes. So I, as a broker, our pricing's been pretty consistent since day one. We charge a 10 basis point placement fee on premium as it comes into the policy.
Yeah.
And then we have a servicing fee that is part of the carrier's mortality and expense fee that averages 5 to 10 basis points. We've never
Okay,
gone
and
above
then-
10. Yep.
So, well, I'm sure you have startup costs, and that's a percentage of the policy.
We do not, again, as a broker, we do not. No.
Oh, okay. That the carrier will. Okay.
The carrier has like premium tax that they'll charge, but that is, that's something that goes right to the
To the
respective,
carrier. Yeah.
to the tax. The federal government gets 1%, and the state premium tax varies by the situs of the owner. So you have states
Right.
like Alaska and South Dakota that are
Okay.
very tax favorable. Yeah.
So you're 10 basis points, and then the broker would be around, I mean, not the broker, the manager would be around 75, 80. And then
Well,
the
then-
cost of reinsurance, what is that like?
So we say the average annual cost of insurance is typically in the neighborhood of 25, to 35 basis points. It varies on what someone's underwritten at.
Mm-hmm. Got it. Okay.
We're priced very differently, than Evergreen.
Right. So about 50 basis points. Right. Okay. Yeah.
So if an insurance carrier charges, if their mortality and expense fee, for example, is 45 basis points on the first 10 million, and then it goes, 40 from 10 to 40 million, we are part of that mortality and expense fee.
Okay. And last question. I mean, what Evergreen does is they could do take options as premium. Do you do that?
No, we do not.
Okay.
So it's the carriers we work with. The policies must be funded with cash. They view to accept it other than cash as an investor control violation
Yeah.
because the monies are coming in.
Right.
Yeah.
Right. Correct. Okay. Thank you.
Yep.
Listen, those are great questions. So appreciate that.
Yeah.
I think we have time for one more question because we do have a hard stop and we have to get ready for the next session. But is there any final questions from the audience?
Hey, Mark, this is Muthu.
All right, Matu, how are you, buddy?
Hey, very good. How are you? Thanks for arranging the call. So I would like to do some follow-up on this. So what should I do? Like if I have is there a possibility to do one-on-one?
The answer is absolutely. Remember, our objective, our role here is to empower our audience, our network. So we have Jennifer as a subject matter expert here. If you just send us an email, I'm happy to do a joint intro between you and Jennifer, and we can arrange that for you.
That'll be great. Thanks, thanks, Mark. Thanks, Jennifer. Great info. Look
Thank
forward to
you.
talking to you more.
Me too.
Well, that was a short question, so I have,
Eh,
there is one more.
No, I mean, I have a lot of questions. So, I mean, I'm especially interested in the hedge fund model for the insurance. So, I think it will it will need more than a couple of few minutes to discuss.
Well, let me plant a seed for you, Matthew. So when you do speak with Jennifer, maybe it'll be more productive or maybe not, but I'll give it my best shot. So you are in the hedge fund business, and the insurance carriers essentially have products on their platform that they vetted, that they allow people buying these policies to select some of those menu options. Okay. So done right, it's a phenomenal way for you to acquire net new assets by being on an approved platform, whether it's a Zurich Re, Swiss Re, or whoever it is. That is a possibility. Now you have to go through their underwriting to be approved on their platform, but that could be something you should consider looking at.
Exactly, that's the idea. So, I want to value add for the current investors. So, definitely, this is something very useful. Thanks for organizing this call.
No, it's my pleasure. So I'm going to end it there, but I
Okay.
really appreciate everyone being on the call. And Jennifer, I thought you were terrific. So thank you very much.
well, thank you for the opportunity.
And I wish everyone a phenomenal rest of your day, and we'll all talk soon. We will be having another session next Thursday. So looking forward to our next event, and I hope everyone has a great rest of the week.